So let's start at the beginning.
Sure.
Maybe you could give us a little bit of context. Why did you start AQR? And how did that come to be?
Am I allowed to say greed?
Sure, sure.
I think it's probably a rare person who says they started an asset management firm, and that would not be part of it. I'm also very conscious of answering this question with one of my early mentors, John Corzine from Goldman Sachs, in the back, because he's the guy I quit to 21 years ago or so. And I still feel bad about it, John. He was very kind to me, and I wouldn't be here today if he didn't take an interest in my career. But primarily, I think of AQR as a research institution. We're very applied. Ultimately, that research has to either directly or down the road make clients money, but it's a research institution. And we wanted to be able to go anywhere, do any research we wanted. As much as we loved being at Goldman Sachs, and they took a real chance on us, we weren't very attached to Goldman Sachs. We were kind of a separate group. So I don't think that's long-term equilibrium, to sound like an economics geek. When you are your own bubble, and the asset management industry is a profitable thing, both the independence and the greed. It was hard. I said no for about a year to various people who asked me, and then I caved. I'm glad I caved, but it was a tough one.
Okay. So could you maybe explain, give us a little bit of context. How is your strategy different, unique, et cetera?
For one thing, this is going to be terrible marketing, but I think we embrace the non-uniqueness of a lot of it. I think, and this is a broader statement, I think a lot of quantitative investing in particular gets labeled as very esoteric or impossible to understand, and that is true of some of it. If someone's built a giant machine learning program on a new data set, nothing good or bad I'm saying about that, but that may be hard to understand. I think the vast majority of quantitative investing, what's come to be called factor investing, smart beta, a term I didn't like for a long time but now use because everyone else uses it. You can't fight language, by the way. Language is democratic. If you continue to fight language for a very long period, eventually you're just a bitter old man that no one understands. So you just have to say, I lost, and kind of move on. But if you asked me the same question maybe 20 years ago, I think, not a sea change, but I think I would have answered differently. I think I thought more of what we do was unique. For instance, I used to, and I admit this, kind of roll my eyes when I heard active stock pickers describe their process. And it's not that I'm a pure efficient marketer, though that's my deep background. I'm clearly not there anymore. It's not that I don't believe some people have alpha, but it's that 9 out of 10 presentations use the same phrase. We look for value plus a catalyst. And I go, oh God, another value plus a catalyst. And I wrote my dissertation on combining two quantitative factors that systematically look for cheap and expensive stocks and good and bad momentum stocks, and try to buy the stocks that are cheap and getting better. And it was a client meeting, which is quite humbling, where I kind of somehow that came up and I rolled my eyes at it, and they said, couldn't you describe value and momentum as value and a catalyst? And I'm like, yeah, damn. I had no response to those. So, and as you roll through, the list of quantitative factors gets exaggerated sometimes. I don't think there are 1,000 different things. I think you're pretty bad at quantitative management if you believe all 1,000 studies that report to have found something. I think the core set of, call it 5 to 10 principles that most of the big credible quant firms, unfortunately, I wish they'd all forget them except for us, agree upon, are try to buy stocks at reasonable prices that are profitable, good companies that are lower risk than the alternatives and have started to get better in both price and fundamentals.
Right.
I don't think that sounds like an extremely unique investment strategy. I think good active managers often pursue a very similar investment strategy, but their job is to identify the 20 companies that have those characteristics and are special. Quants totally give that up. We don't know.
Right.
The question I know you won't ask me because you know too much. but I get asked all the time is what's your favorite stock? What's your biggest overweight? And I love the look of sadness, anger, even disappointment when someone says, what's the biggest stock you own? And I go, I don't know. Because as a quant, we believe in these ideas, not any particular name. There may be thousands of stocks long and thousands of stocks short if it's a hedge fund, or overweight and underweight if it's a traditional portfolio. There's lots of unique things. We just wrote a paper we arrogantly call Craftsmanship Alpha, which is about even if you believe in these factors, there are tons of decisions you have to make. And of course, by definition, after 20 years, we think we've made some progress on that. The unique stuff, of course, I'm not allowed to tell you about. But I will admit it's smaller. It's a smaller part than I think a lot of what quant is about taking good investing that we would share these ideas with more active managers and saying we're going to do it systematically at a lower fee. It doesn't replace other kinds of investing, but I think it's less unique than others think, which actually gives me more confidence because I think they're principles that are real, not fly by night.
So let me ask you, so I think in a nutshell, quant strategies, typically quant strategies are based on a variety of back tests that you've determined that these particular factors align, et cetera. How do you actually verify that the back tests are actually going to work out in real life? Because it all sounds great on a back test.
Oh, we don't care about that. Just get it working in real life, that's a nice bonus. First of all, I want to immediately take this down a notch because you said verify. We never are sure. This is a distressing part, and I think anyone who's ever sure they're right is a little scary. But as a statistician, you know there's some chance you're right by dumb luck. Even if it's worked in real life, it could be dumb luck. I am fond of saying if you don't fulfill a few of the criteria I'm about to share with you for how we actually maximize our belief, not assurance, but maximize our belief, you wake up, once a night in a cold sweat that it's not going to work, it's not real. Our goal is to reduce that cold sweat to once a year. I won't say once a year I don't wake up saying maybe we've just gotten lucky for 20 years. But that's just intellectual honesty. There is a chance that has happened. So what do you do? Let's say someone has a back test and they say I've produced these returns. There are mundane things you do. You make sure it's a realistic back test. It's trading liquid stocks. It's taking out transaction costs. But even there, it could just be random luck. Basically, three things you look at. One is obvious. You look at the actual backtest itself. This is not nearly enough, or else you're just data mining. But I don't know anyone who runs a backtest and says, I can prove this has failed for 50 years. I love it. Perhaps we should. Perhaps we should be so committed to theory occasionally that should overcome that. The late Fisher Black was the only one I ever knew who actually proposed this. I was young and in awe of Fisher. I'm still in awe of Fisher. But he was the kind of guy who he would say 10 things. 9 would be a little bit wacky. And the 10th would be brilliant and something no one else thought of. It was more than worth the price of admission. But once he said that he wants to build a reverse DM strategy. DM stood for data mining. Of course, I didn't know that, and I spent the entire meeting wondering, is he talking about the Deutschmark? There was a Deutschmark at the time. He actually wanted to go long stuff that hasn't worked for 100 years. Because, people have to be overexcited about it by now. So has it worked over the long term is a gimme. You don't see a backtest that hasn't worked. The next is economic plausibility. If someone, and these exist, perilously close to as silly, I'll come up with an extreme example, but you can do a back test where you find CEOs with the following middle initials, you go long their companies, with the other middle initials you go short their companies. I promise, I have not actually done this exercise, and that should be comforting to you that I haven't done this exercise, but I promise if we try enough versions, you'll come up with something with a good back test. I hope everyone in this room would dismiss that. Another famous, very American-centric example is the famous Super Bowl effect. Buy after a team in the so-called NFC wins the Super Bowl, sell stocks. This is a timing rule after a team in the AFC wins a Super Bowl. It's even data mined to the point where I'm gonna drop some U.S. football knowledge. Somewhere in the 50s, 60s, 70s, I'm not sure, leagues merged and a few teams moved from one conference to another. So you also want to go long if one of those teams won in the wrong conference. And there's a real hint, data mining is going on. It didn't work quite well enough. I believe the Pittsburgh Steelers screwed up the back test. So hopefully, if in real life, rarely are you faced with something that's starkly, obviously silly. But there are things that clearly have more economic intuition. Buying profitable companies that have been profitable for quite a while. Even that intuition could be challenged, but at least there's something going on there. Day of the week effects, where people have these really cool results, and then they tell these wild stories as to why people are in a good mood on some days and they come in pessimistic. They're without looking at the evidence, you got to step back and go, I'm going to make a human judgment. People often think there's not human judgment in what we do. There shouldn't be too much on a day-to-day basis. We should be following our process, or else we could undo the very things we're trying to do. But in creating the process, there's a lot of judgment. Right. I've left the final leg and the most important one for last. We live for out-of-sample tests. You always see a good back test, right? But what any kind of statistician or financial researcher, but in any kind of statistical field, you want an out-of-sample test. You want to go see if it worked somewhere else you haven't looked at, where if your theory is right, it should work. That will give you a lot more confidence. I am fond of saying statisticians don't dream about normal things. Normal people dream about, I don't know, nice houses and cars and kids and significant others. Statisticians dream about good out-of-sample tests. We do believe if we attain those, we will get good houses and cars and significant others. So we're ultimately looking for the same thing, but our route goes through out-of-sample tests. The things we tend to believe they were mostly uncovered in the mid to late 80s and early 90s. I'm imagining myself again back in Goldman Sachs. At that time, the best out-of-sample test is as long a period you can. We now have more than 25 years since, this is dating me, but my dissertation data ended 27 years ago. So most of you don't think of the last 27 years as the Cliff Asness out-of-sample period, but that is one way I think of it. It is wonderful to see this stuff, and it generally has hold up for a quarter of a century. That is a great out-of-sample test. It was terrible when I reported to that guy in the back, because to advocate, here's the plan. First thing we do is we wait 27 years. If this stuff holds up, we pounce. It was really not a good business strategy. You can't overcome time, but one thing we did early on was another version of an out-of-sample test, which ended up being a big part of our business, is most of this original research was done on individual stock picking. And primarily in the United States. They're the biggest, largest databases. Obviously, extending it out of the United States was a step. And this was not just us, but we were early in a big part of this. Extending the ideas of quantitative investing to other asset classes, to asset allocation, picking what country to be in, what bond market to be in, what currency to be in. This stuff never works perfectly anywhere. It always works a little more often than it doesn't. You have to watch me. Sometimes I use the word works like I'm a regular person. If your auto mechanic used the word works like this, you'd fire him. 6 out of 10 mornings is not very good for your car to turn on. It is very good for a strategy. But if value and momentum, which are not all we believe in, but maybe the two grandparents of the factors out there, if they work for picking individual stocks, if you can come up with a good definition of value and momentum's always easy. It's easy to come up with a definition of momentum. Value is sometimes you actually have to think about for a bit. But if you can look at currency markets, bond markets, commodities, other markets, and come up with a definition for those, test these ideas that you've never tested before, and see results at least reasonably in the same direction as we did. That's an out-of-sample test of a different kind. And that was the only route available in 1990 because there was no other path. So I would say, sorry for the very long-winded answer.
No, it's good.
But a good back test, you need that. But economic story, do I buy this at all? Is there a smell test involved? And then, can I find other places no one's looked yet? That is probably the most important thing. And there often are. You can often get creative and go, if this is true, this should be true. And if it's not, it makes me question my original hypothesis. And then you get to once a year in a cold sweat, because even those could be luck.
Right, right. Thank you. So I read a quote from you once that went like this, and I'd love to hear, to have you elaborate on it and let us know what you meant by this. Saying that I have a pet peeve or some pet peeves just doesn't do it. I have a menagerie of peeves, a veritable zoo of them. So could you maybe share with us one or two of your investing peeves and what you meant by that?
Well, I'll tell you the origins of this story. I was lucky enough, the then editor of the Financial Analyst Journal asked me, invited me to write an editorial. They do this occasionally. They just pick someone, and it's a little different. Normally, I, like everyone else, submit papers as a referee. This is allowed to be more opinionated. And I said, do you have an idea? I can come up with one, but do you have an idea of topics? And he said, I think I've gotten better on this front. But he said, you were always angry about something. You'll come up with something you want to rant and rave about. Come up with your pet peeve. And I produced a list of like 15 of them for him. I sent them back to him. I go, again, I'm trying to do what the journal wants too. And I said, which of these would be most interesting? And he goes, why don't you do them all, just short? So I wrote a paper, an editorial for them called, I'm going to mangle my own title. I'm going to get it approximately right. My top 10 investing peeves. This is not my top 10 life peeves. The fact that satellite TV doesn't work in the rain, even though they tell you it does, is not on the list. And that list, I won't go. I will spare you the entire list. But it's a mix of the serious and the more what I think are a little more whimsical. They're still serious, but I'll give you one of the whimsical ones first, and I'll give you a serious one. I had a list of phrases that I want to ban from investment commentary, mainly from the same TV most of us have on all day, but other places. And one of them was a comment on, and I do it too. I still use the phrase, even I'm a hypocrite on these things, but a comment on how much cash there is on the sidelines. I don't like that phrase. I know there are many of you who use it who now like me less than you did a minute ago. I know what people mean when they say it. They're making a statement about sentiment, but the economist in me recoils from it, because I'm going to argue to you there's never literally cash on the sidelines. If Mo wants to go to the sidelines and leave his stocks because he's nervous, what does he do? You sell stocks, and now you have cash. Somebody else gave you cash and now has stocks. You have moved to the sidelines. They have moved off the sidelines. Stocks and every other asset are always fully owned. If one wants to save this, there's a really long-term version that can work, because over time new stocks can be created or bought back. I don't think that's what people generally mean. I think that's a desperate attempt for me to be nice and save the phrase. So if people just want to say there's a lot of jittery sentiment, I think there's a lot of money ready to buy, that's fine. But there's not really cash on this. Those sidelines do not exist. And as you can tell, these things drive me a little mad. A somewhat more serious one was, and this bears on this what we started with, a little bit of the interaction of quantitative versus more traditional management, is quants take a lot of guff for using volatility as a measurement. And a lot of very smart, very accomplished people will talk about how silly that is, and real risk is permanent loss of capital and whatnot. And I don't disagree with people who say that. I just think this is more of a communications problem. First of all, of course, real risk is permanent loss of capital. If you assure me a loss is temporary, and for some reason I believe you because you're godlike in your powers about this, I am not upset about that loss either, even as a quant. We're all worried about losses we don't get back. I think there's an assumption that quantitative people, who by the way don't just use volatility as a measurement, the idea that all quants think the world is perfectly described by a bell curve, does not. You have to be a pretty bad quant at this point to think the world is perfectly described as a bell curve. My dissertation advisor, the godfather of efficient markets, Gene Fama, wrote his dissertation on the fact that stocks have very fat tails. They're called, meaning they're not a bell curve. It's a ugly way to say big stuff happens. He was Nassim Taleb 30 years before it was Nassim Taleb. So I don't think we all believe that. But the inference is often that quants can be very naive. If something is low volatility, but very expensive, a quant will stupidly love it because it's low risk, when it's just going to lose money over time, and that's not low risk in a more grand sense. There's a communication problem. They forget or don't know that there's more to a quantitative model than risk. For instance, in the most simple approach, there's also something called expected return. We don't just care about risk, we care about what we're going to make. And one major feature of most, and certainly including our quantitative models, is valuation and quality. So we can think something is low volatility and think it's terrible because it's expensive and a bad company. And we could have on exactly the same underweight or short position as the more judgmental active manager does. We just get to it through a different route. So that was another peeve of mine, is people keep telling me I don't care about permanent loss of capital. And I promise you, I care desperately about permanent loss of capital. I can't always prevent it.
So on the prevention side, could you talk, and this is a question I'm going to ask virtually every speaker today, talk about some of your most instructive mistakes.
Oh, there's so many. I will pick one. This goes back somehow, and I don't mean to keep bringing him into my talk, but John Corzine being in the room makes me think about my Goldman days and starting AQR. So this goes way back. At AQR now, and even at Goldman more than 20 years ago, we ran using the same models. We didn't have different investment approaches, but we ran a whole gamut of different investment strategies. We ran traditional kind of beat the benchmark, no hedge fund aspect whatsoever, no long, no short, excuse me, you're allowed the long, no shorting, no leverage, traditional. We ran so-called hedge funds that would be long and short all the things that we liked and didn't like. We ran some at very low risk for people who wanted to earn a little bit more in an uncorrelated way, and we ran some at very high risk. When we went to start our own firm, you can't launch a gamut of products at once. For one, you can't launch traditional products at all. At least this was the case in 1997, 98. To launch a hedge fund, you have to say we're oversubscribed and we're closing. And that was very easy to launch. To launch a traditional set product line, even if we had been running one for multiple years before, people said, we need a 5 to 10 year track record. And implicitly, they didn't say it this way, but you need to look like I look now, not like the full head of hair, brown hair, I might add, I was in 98. You need to have some experience, which is always odd, right? To run a levered, long, short, perhaps very aggressive fund, yeah, we're in. But to run something staid and boring, you needed something else. So we decided, we didn't even decide, it was the only path, to launch with the hedge fund version of what we do. And here's a place where we did make a very poor decision to finally get to your question. We launched a very aggressive version of what we do. We launched a version that would take, I'm going to use volatility now, not permanent loss of capital, north of 20% annual volatility, meaning we were attempting to be uncorrelated to markets, meaning as short as long, but we still fluctuate. And those fluctuations would be bigger than stock market fluctuations in general. That's quite aggressive as a standalone product. We thought it's a great addition because volatility is fine. Uncorrelated volatility is something you want to add to your portfolio. But we had so many investors come to us and say, hey, this all sounds good. We had people who said it sounded terrible too. I'm gonna ignore that. But we had people who said, this all sounds good, but we don't need to try to make 20, 30% a year. Can you run something for us at half the volatility, at a quarter of the volatility? I always responded the same, very flip response. I know none of you can imagine me giving a flip off the cuff response, but I was younger. And I responded, you want a quarter of the risk? Give us a quarter of the money. And I promise you my math was accurate. If you give someone a quarter of the money, You're taking a quarter of the risk. It's completely fair because you're paying a quarter of the fee. One problem we have with both hedge funds and traditional active management is some form of benchmark hugging, where as someone gets bigger, they take less risk, where effectively they're charging more for the same product. This is a fair version. You want a quarter, the fees go down by a full quarter. So I thought that solved the problem. What I didn't realize, because let me also tell you, we had a really bad first 18 months. We had a really good first month. And then we had a really bad 18 months. That was the tech bubble. I'm dating myself again, going back to 99, 2000, where things like momentum that we believe in worked. They didn't work nearly as well as value worked poorly. Like I said, even the combination works a lot more often than either individual strategy, but it doesn't always work. I'm here because it more than made up for itself in the next few years, but it's very harrowing. And I learned something that everyone in this room knows already, but I had to be taught. That having a really bad start at 25% volatility is a lot worse than having a really bad start at 5% volatility. A 2 standard deviation event is you've lost half the money. A 2 standard deviation event at 5% volatility is you've lost 10%, which stinks, but it doesn't get you headlines in a newspaper. To a pure quant geek, these are the same events. If you told your investor before the fact, we're taking 5 times the risk, we believe in this process, and you got a bad period, shouldn't change anything. I had to actually learn, I know you're all amazed at how stupid I was, but I had to actually learn that that's not quite true for the real world. It wasn't quite 50%, but when you suffer really large losses, people start, whoever you report to, they might even get it, but they report to someone else. And there's an investment committee at the end of the day. And the investment committee doesn't go, who's had the largest standard deviation event in the last 18 months? They go, who out there sucks? And sucks is denominated in dollars, not in standard deviation events. So they ask for a list of their managers, and if you have a bad period at a designed high volatility, you told everyone, you're the bottom of that. So it's a simple fix. Not only, of course, do we get into more traditional investing, but we, within reason, largely let our investors choose how aggressive. We still fix the fees, to be fair. We still offer aggressive products, but I find if you offer both, and the investor, this is all about behavior. We believe in these things. It's just how we're all going to behave going forward. If an investor sees their low-risk version and a high-risk version, and they choose to be in the high-risk version, you get some real buy-in. They've consciously gone through the process with you. They've made that choice. When you say there's only one version, it's on you. So again, I'm sorry if this seems staggeringly obvious. I still kind of rage at the fact that my math was accurate. But how to get a real-world lesson the hard way.
So just for a minute, just to digress from finance for a second, is there, and we're going to come back to some financial topics, but is there a motto you live by? And maybe also, if you could also talk about some of your interest outside of finance.
A motto,
for a minute or two.
A motto I live by. You've already sensed that for a minute or two thing doesn't work for me. But my family, this is like 15 Thanksgivings ago, we once voted on a motto. This is not my personal motto, I hope. But there were a few contenders, and the one that won was the phrase, "Are you going to finish that?" Which I think is fairly... most of my favorite quotes, which I guess are the closest thing, I don't have a personal motto, most of them are either by Churchill or made up and put in Churchill's mouth. You never can tell if he actually said it. I find Americans like Churchill far more than Brits, and somewhat more than the rest of the Commonwealth. So we're still a little enamored with him. They're all rather martial, tough guy quotes. One of my favorites is the phrase, not a phrase, is a quote. He's talking to a young man and he says, "Do you have enemies?" "Yes." "Good. That means you've stood up for something." I maybe have, enemies is too strong of a word, but I have a few nemeses. He has a wonderful quote, again, I won't call it a personal motto, that is a wonderful balance of extremely egalitarian and horribly egotistical at the same time. He says, "All men, including me, are worms, but I do believe I'm a glowworm." And again, I don't know if you pull that a lot. You pull that off better when you're 70 years old and you won World War II.
Right.
So I'm not going to make that my motto, but I always love that one. Personal interests, I don't have a lot of time for personal interests, and it's not that running AQR is that hard. It's having 4 children with 1.5 years between them. We had 2 sets of twins 1.5 years apart, which is the finest statistical event in my entire life. My wife used to get mad at me when I would refer to our family planning as, quote, a gross failure of risk control. She didn't think that was the most romantic way to describe it. But now they're teenagers, so they're 13 and 14 years old. And if you think you have a lot of time in your life, soon, sadly, in some ways, we will have a lot of time. But 4 teenagers of approximately the same ages keeps me going. But outside interests, I wasn't prepared to do this much of a suck up to my audience. But coming to Canada and say your main thing you do outside of work is ice hockey feels a little suck-uppy, no? But yeah, I'm kind of a rabid Ranger fan. My son plays hockey. I'm mostly watching. I've only played a little bit. With a lot of my Canadian friends, when we talk hockey, they tend to tell me things like this. That's impressive. You know way more than almost anyone we've met from America, and as much as the average Canadian 9-year-old. Because I only know my team. I don't know all the other teams. But Rangers were down 4-2 last night, and they came back to win 6-4, and they desperately needed it because they have started horribly. Not quite, you know.
Congratulations. So let's come back to finance.
I have a paper coming out on a topic that I've only seen Canadians write papers on, but there are quite a few.
What's that?
On what's the optimal time to pull a goalie. It's a wonderful sports thing. We talk about this because there are lots of analogies to risks that are good risks, bad risks, direct analogies to option theory. It's basically the same concept as pricing a call option, because it doesn't matter how much you lose by. You only get the upside. Volatility is your friend. You accept a negative expected return to get volatility. And we, like many of the other papers, we come at it differently. We find out, we believe that coaches pull them too late. And I think the NHL has started to move in that direction, but we think 2 to 3 minutes would be better than, a minute to a minute and a half from the math.
Right.
But like so many other results in sports and investing, and we make this analogy, the unconventional choice that will get you yelled at by the media when it doesn't work, going for it on 4th down in football, a lot of the going for the 2-point conversion in football is underutilized, and we find the same in hockey.
So again, behavioral. So let's come back to this, because it struck me that a lot of some of your most formative years in the asset management business have been in the late 90s. So has your thinking about investing changed since '98 till now?
Yeah, I'd even go further back to 93 when we formed this group at Goldman. I wrote about this a bit when Gene Fama split the Nobel Prize with Bob Shiller in kind of give half of it to efficient markets and half of it to the opposite of efficient markets, behavioral finance. This is unfair. They actually split it 3 ways. There's a guy named Lars Hansen. But Lars is almost all about the math and is not fighting with anyone. So no one ever mentions Lars, so let me give him that shout out. But when they split that, we got asked by institutional investor, myself and one of my partners who was also a Fama student, to write kind of a retrospective on what this split means, what the efficient markets hypothesis is. It was an institutional investor. And it made me think about this same question. And if there's a spectrum from efficient markets, the only way to make money is to take a risk that's rationally priced. Things are not mispriced, to wildly inefficient markets. And Bob is in this direction. He sees a lot of bubbles. He thinks volatility is way more than is rational. There's a spectrum. I think we started out, myself, in the early 90s, short time out of grad school, never at the full efficient markets. I wrote my dissertation, for God's sakes, on the success of the price momentum strategy for Gene Fama. If you say it's a failure, that's a great Fama dissertation, right? A bunch of people, applied people, buy what's going up and sell what's going down, and they lose a lot of money, ha ha ha. That's implied. We don't write the ha 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 in the papers, but it's implied. But a Gene Fama dissertation is not, you can make money
Right.
doing this. So already I had drifted somewhat, but I was still probably closer to Gene. I am firmly in the middle. I think that's the experience. Maybe I'm overscarred by this, but living through both the technology bubble and the GFC, if that doesn't move you somewhat on the spectrum away from how perfect markets are, and even Gene won't, I gotta defend him for a second, he doesn't say they're perfect, but he thinks they're closer than most of the rest of us do. If anything, I'm probably at the margin more of a behavioralist than an efficient marketer. And that's, I think, living through the world. Very related to that. My firm and myself have never been very big believers in something closer to market timing. We've always thought things like what we do work much better when you can make many decisions, great breadth. We are less of a believer than we were 20 years ago. We won't go to zero. This frustrates me because it's always easier to explain something by being either a huge fan of it or saying it's terrible, do none of it.
You're less of a believer, just to clarify?
Sure.
You're less
Market timing.
Of market timing.
A colleague and I, Antti Ilmanen, this is a good day, because about half the time I can't actually say Antti Ilmanen correctly on stage. He's Finnish. Wonderful guy. But we wrote a paper together whose title, it's about market timing, is Sin a Little. And the point is, we think market timing is a sin, and one should sin a little, not zero. The same forces that we believe in for the cross-section, for picking which stocks, for picking which countries. Value and momentum, again, are the two biggies. There are others. Cheap markets that are starting to get better, we would do a little market timing, but a smidgen. And a third of the smidgen that we would have done 20 years ago. It is a harder way to make money, both practically and theoretically, than we used to think.
So if we could maybe dive into that little sin, and looking at where we sit today, where would you see the risks and opportunities, unique risks and unique opportunities in today's markets? Well,
first I'll give you, after telling you it works really poorly and it should be a tiny part of your portfolio, I will of course now share my market timing opinions from a value and momentum framework. Don't do this at home. I have to say, don't do much of this at home. The stock market, and this, broadly speaking, the world stock markets, and a lot of our models do overuse U.S. data, not because we're from the U.S., but because we have the longest data sets, which I still don't understand because we're one of the younger countries in our data pool, but we have the longest data set. In the U.S., I think your intuition would be exactly right. If you're a believer that two of the biggest forces are valuation and trend, is it cheap and is it getting better or vice versa? You're pretty neutral right now. These are fighting each other tooth and nail. The market is quite expensive, but you may have noticed it's trending positive on any way we can measure that. The bond market, which we've generally been wrong about, and this is a good example on sin a little. We've had perfectly fine period while being wrong about value and momentum for the bond market. Those two signals do not like bonds. Bonds are expensive, and finally, they don't have really terrible momentum or trend, but not what it was. So now they're expensive without a very big uptrend. So if you believe in that philosophy, and I do, I would sin a little in those directions. When you talk about the greatest opportunities, this is generally a bad question for a quant. You're too good to have asked me my favorite stock, and it's not nearly that bad, but it has a little of that flavor to it. The few times where we've thought there were awesome opportunities, and we were never 100%, but really, really close to certain, we had to go through hell to get there. Peak of the tech bubble after losing a bunch of money, we thought value investing at that point was an epic opportunity. When it would exactly turn, we didn't know. The bottom of the GFC, not necessarily markets, but strategies like convertible arbitrage, merger arbitrage that were utterly destroyed. They weren't guarantees. If the United States nationalized the banking system, they weren't going to work out. But I used to say, if there is a banking system going forward, this is a lock to make a ton of money. But be careful what you wish for. The times where quants have really strong opinions tend to be after some fairly insane events. So I don't see anything now where I would say, don't diversify across these 50 things that we like, to be parochial. Put most of it in this. Very rarely and occasionally I do see that, and I don't want to ever see it again. Because to get to that, I probably have to go through, round 3 in my life of dealing with some severe pain.
Right.
If I was a completely cold-blooded Vulcan, I should want this, because the round trip has been good to us. Crazy things that you never, even with momentum in your process, you never get it exactly right. If valuation matters to you, you're always early. So it's excruciating. They have worked out for us, but I'd be fine with making a steady amount of reasonable money and never having those glorious opportunities again.
Right. So you briefly alluded to passive investing, and what do you think that, as the world shifts, or the financial world shifts more towards passive investing, away from active managers, and you'd certainly be an active manager, but what do you think what are some of the second order effects of that? What may be some of the ramifications or anomalies that might create?
Mo, you got it right. A lot of people, particularly the financial media, will use quants and factor investors and smart beta synonymous with passive investing, and you didn't. You said we're active. I like to describe it as if I had my druthers, again, I don't get to decide vocabulary. I've tried. I just failed. I think of us as systematic active. We take different positions in the markets, and in hedge fund portfolios, we're long, short, and levered. I don't know how people call that passive, but sometimes people think if you follow a model or a process, it's by definition passive. So I think the move we've seen...
Well, nothing is really passive.
Yeah, there is that. There are always... It starts to get perilously close to philosophy, but there are always decisions...
We'll skip that discussion.
...to be made. But you see the same thing we see. There's been a move away from traditional active towards two very separate things that I think the media sometimes conflates. To true passive, never fully passive, but call it cap-weighted, super low fee, and systematic active. And we've been a beneficiary of that, I will readily state. I think those are, again, I'll argue with people if they say these are similar, these two branches, but they are motivated by something similar. A general feeling that people have not gotten their money's worth from traditional. Some people throw up their hands and go, I'm abandoning the whole game and I'm going to Jack Bogle. Some say, I'm going to do fair. Remember I said, I don't think what we do is that unique. I think it's fairly traditional security analysis, just done in a more quantitative and a lower fee way. So some say, I'm going to get it this way. Going forward, everyone rational agrees, bold statement, I'm just asserting this, that a world with no active stock pickers makes absolutely no sense. This is the kind of thing I've joked about this, I've written about this, that a bunch of drunk PhD finance students at 2 a.m., this is what they talk about. Hey, what if there were no active managers? That sounds more high than drunk. I don't know how to do that. And it's a really weird world, right? No one knows what that means. No one is out there trying to figure this out. We absolutely need active managers in the system. A giant question is how much. I think passive is still not half of the assets out there. Jack Bogle conjectures, he goes up, he changes the number around sometimes. Sometimes it's 80, sometimes it's 90% of the market could be passive and still work. I think that's a little high, but I don't think we're there yet. I think we need active management, but we don't necessarily need as much high-priced active stock pickers. We need good ones, and we need them, but I think this movement is not at a danger point for the markets yet. So I think its effects are, if anything, somewhat exaggerated and over-worried about at this point. Passive for a reason. The one wild card that nobody really knows is if and when, I should say when, because volatility will return at some point, but if and when something really bad happens, how people who've sworn they're long-term passive holders, and that's a change for them from 5 years ago, they've moved to that, how they will behave. I don't mean their managers. I don't mean active alpha. I mean, are they more hair-trigger than people before, or have they really bought into it? If they've really bought into it, then we're going to have a more stable market in those events. If they've not, and I'm a little scared about that because I don't know, we could have uglier short-term events.
So if I were to ask you a similar question on factor-oriented investing, which is a world that, quite frankly, you were one of the pioneers of, that seems to be getting bigger and bigger as well. Are investors entering a crowded theater at this point, or is there any concern of that?
Of course there's concern. I started writing on this on our website 3 years ago, in 2014. And there's been a series of papers by myself and others debating where we are. One thing I find some comfort in is this is a hard way to, this is odd to think about, but we all know what we mean when we talk about valuation of an individual security. We may totally disagree on that valuation. We may disagree on what the best measures are, on even the inputs. But we get the concept. This is an expensive stock. This is a cheap stock. Factors have a price also. If one factor is however you measure cheap and expensive, value factor, you go long the cheap and short the expensive. Sometimes there's a very big difference between those. Sometimes there's a very small difference. My old buddy, the tech bubble, was the biggest difference between those ever. In that sense, that factor was very cheap at that point. Other factors, if you like profitable companies and you go long, maybe you do it within every industry and you have all kinds of risk control, but you're long the profitable companies, short the unprofitable companies. You almost always have to pay up in terms of traditional valuation ratios. Markets might not be perfect, but they're not quite that asinine. You pay up for the more profitable. But if you're paying up a lot more than you used to, maybe that's a sign a ton of people have moved to your profitability factor and raised the price of that factor. It's a long-winded way of saying, of getting the conclusion that at the end of the day, we're fairly comforted. The factors don't appear to be much more expensive than history, and certainly not in the ballpark of stocks and bonds, where you see CAPE ratios that are 90th percentile, real bond yields that are 0th percentile. 0 is low, by the way. You share that information. The one factor out there, the low risk factor, which some of you might have heard of, people measure it in all different ways, some fundamental, some more using quant geek measures like volatility and beta, but low risk stocks, risk adjusted, tend to outperform high risk stocks. That is the only factor we find to be pretty expensive versus history, and even that looks like what I would call pretty expensive normal. The expensive end of a range we've seen many times in history. Again, my favorite whipping boy, the tech bubble, we blew away normal. We weren't expensive normal for stocks. We weren't cheap normal for the value strategy. We were 3 times as cheap as we've ever seen before. The graph looked like, here's 100 years, that. That is not what we're seeing even in the worst, the most expensive of the factors. This is all good news. This says to me, we have not priced away these factors yet. One of the reasons we may not have priced them away yet is because it depends where the money's come from. If the money has come from active managers with a very similar philosophy, remember I started out saying I don't think we're that different. They're looking for similar companies. They're just doing it more bespoke and charging more. Mm-hmm. Then we don't necessarily have to influence the prices as much as we think. As a group, they might have been doing something fairly similar to us.
Right.
Another possibility, which I hate, is perhaps we're just less important than we think we are. That this is a big movement to us, but in market terms, they're big, deep, and liquid. I will say this. I feel very comforted that the long-term outlook has not changed that much, because I think the long-term is the reign of price. If price is fair, the strategy is good, the long-term expectation is still very good. I do think we live in a less stable, scarier world when something is popular. When many people are doing something similar, even if they've not moved the prices to an irrational level, you still run the risk that tomorrow a third of your competitors take off a third of their positions for whatever reason. If that happens, you're going to have an exceptionally bad day tomorrow. If you are the only one to know about a strategy at the same prices in this example, your long-term returns are not better just because you're the only one who knows. Prices govern. They're good, but they're not better. But you are probably not susceptible to great turbulence, because the chance that a diversified portfolio of, say, longs and shorts is precisely traded against when you are literally the only one who knows the strategy is not zero, but is very small. Mm-hmm. When your strategy is popular, if my 3 biggest competitors, all for whatever reason, do something radical, We all have a very, very bad time. This is not theory. In August of 2007, this essentially happened. People tend to call it the quant crisis. It really did happen. It was a disastrously bad 5 days or so, and then all of it came back like liquidity events tend to in the next week and a half. We largely did what we expect to do in the next one. We did very little. We rode it out and things were fine. But I do think the popularity has not priced away these factors. And in an expensive market, I don't think you have a choice of saying, hey, if other people know about it, I'm out. But they have raised short-term turbulence risk.
So one of the things, so you're referring to sort of the popularity and the kind of cohesiveness amongst investors. The market seems to also be driven by the popularity of individual names. So, all of a sudden, Apple's, Google's, Amazon's start driving the market much more meaningfully than in the past. What does this actually mean? First of all, how unusual is that? And then secondly, what does that mean for the way that you're investing?
Well, I'll take the second question first. It doesn't really mean very much to us. On a given day, of course it can matter, but our portfolios tend to look globally like many hundreds, getting near 1,000 stocks long and short. Our positions in individual names tend to be very small. The few times I've heard about individual names have uniformly been bad news. Again, I'm overusing it, but the technology bubble is the best example, where you take a 0.5% short position that shouldn't kill you, and the stock in the aftermarket announced that they're not going to charge anymore, and therefore the stock price tripled. It's kind of how it worked back then. Now, suddenly a 50 basis point position is 150 basis points of losses. So most of my life, including even back then, was very survivable. Individual names don't matter. Which side we're on Facebook matters a smidgen. It, of course, matters a lot more to managers who are concentrating and making these decisions. But let me answer your last question. How abnormal? I haven't updated this a while, and they've continued to do well. These FANGs or FAMANG, whatever they keep changing the acronym. So maybe I have to amend this, and maybe it is weird. But we looked at it in the last several years of people talking about this, and the FANG performance. I'm just going to say FANGs for all the different permutations. The FANG performance was off the charts. But we did an exercise where we went back many, many years, and we said, what if you always chose the 3 or 4 big winners? By definition, they've crushed the rest of the market. How much do they normally win by? And the FANG victory was very similar to the normal victory of the winners. So in that sense, it is abnormal for these stocks, and if you own them, it's wonderful. If you didn't own them, it's terrible. But there are always, there is almost always huge winners and huge losses, and I don't think that the last couple of years are as abnormal as many do. With, again, admitting I haven't updated this study in 6 months.
Okay. We're running short on time, and there's far too many questions here to ask, so I'm just going to maybe at least get 2 in. First of all, I'm going to presume that you make the investment decisions for your family. Is that correct?
Yes, for now.
For now, okay. So how do you invest for your children, for your spouse, for your family in particular? I think I better answer this way, right? A diversified set of AQR products, including exposure to beta factors and our alpha, which is actually honest. I'm probably, I don't think I'm very short term with my own investments either, but one running joke is the partners at AQR, our investments usually get used to start new products and whatnot. So as a physician heal thyself, my personal asset allocation is somewhat random. It is an AQR, but the kids, I'm probably more disciplined, probably more aggressive. I do think some of the common investing wisdom, the time horizon and how aggressive you be should go together. Maybe that'll change when they get a little older and I have to do quarterly portfolio reviews. Right now, bad quarter for quant. I don't get any guff at home. I'm probably just a couple of years away from saying, Dad, has the world changed? And maybe this momentum thing you believe in, and so I'll be getting there. But I run any money for my kids. It's probably the best money I run. So, and again, it's probably setting you up for a slow pitch down the middle of the plate, and that's not how it's intended. But if there was one piece of advice, like, we're fortunate to have 300 plus families in the room, one piece of advice that you would give family offices, ultra high net worth, what would that piece of advice be?
Can I give two?
Yeah, you could give three if you could fit it into the time.
I'll do two. I'll do two. One, and this is not just family offices, this is investing in general. I think people should generally do less than they do. I think we all have a behavioral tendency to overreact. I think it's hard to stick with things. Doing less is an active action. Not doing something counts. And I think it's a tremendous human bias. When we have a bad period, clients want to hear we're making a change to what we do. And we've never made a change just to make people happy. But when I tell people, actually, no, we're not changing a thing, we think we're right, they're not as happy as when we say, we figured it out, we're making a change, which we will do if we think we're wrong. So I've experienced both. So do less is number one. Number two is, this maybe is a hard thing, and maybe I'm thinking particularly about quants, but this is harder than it looks or it should be. And I think particularly about back tests. We talked about it earlier, but I'm going to use it in a somewhat different way. Imagine you see a 100-year back test of a simple value strategy. Anyone looking at that, and imagine you fully believe, I'm going to get that same, I don't know when, it'll be random in the short term, I'm going to get that same 100 years going forward. I'm still a believer. Anyone looking at that is going to say, I want some of that in my portfolio. Why would I not? It's good, it's not very correlated to other things. Living through its bad periods is way harder than you think. When you look at a long-term track record, which is all a back test is, and you go, well, that was 18 months of bad returns, but that's swamped by the good returns. When you're in that period, you get an Einstein-like time dilation where it feels like 50 years. My partner, one of my co-founders, a guy named John Liu, tells me that I did all my aging that I've done, which is considerable since he's known me, during the tech bubble and the aftermath of the tech bubble. Remember, if you're down over 18 months in a day, you don't go, oh, it's all okay now. One good day does not fix your problem. It's, a couple of years till you're feeling good again. But he once told me I looked like Lincoln before and after the Civil War, which I think I've probably honed this comment now, but I think I said something at the time like, well, they are almost the same. He kept the Union together and ended slavery. I stuck with a value strategy. I think those are moral equivalents now. But I do think that's my very quant version of the story. But this is harder than what you think. Sticking with something, fighting your own biases. Your plan, you should method act your plan. There are good plans, and there are people who can stick with them, but it's harder than you think.
Yeah. Cliff, first of all, that was just fantastic. We cannot thank you enough for taking time out of your insanely hectic schedule. We know how crazy it is to join us in Toronto. Really appreciate your participation, and as a very small token of our appreciation, we have a little artwork piece somewhere here, and a donation has been given in your honor to the Sick Kids Foundation. So this is for you.
They knew about the hockey. This is a Ranger jersey in the bottom. That was really great.
Thank you.